Good morning, everyone. My name is John Rendadang, and this is our report screening and selecting capital investment proposals. The fourth step in the capital budgeting process is evaluating or screening project proposals. Once the firm has calculated the cost of the capital for a project and estimated its cash flows, deciding whether or not to invest in the project basically boils down to the asking question: is the project worth its projected future value? Capital budgeting techniques. A. Discounted cash flow time adjusted approach. Under it are net present value method, internal return or internal rate return. Third is profitability index. And the last one is discounted payback period. So, net present value method or NPV. Net present value method is a financial metric that seeks to capture the total of a potential investment opportunity. The idea behind NPV is to project all of the future cash inflows and outflows associated with an investment, discount all those future cash flows to the present day, and then add them together. Internal rate return or IRR. The internal rate return is a metric used in financial analysis to estimate the profitability of potential investments. IRR is a discount rate that makes the net present value of all cash flows equal to zero in a discounted cash flow analysis.
I am the next reporter, Jenny Matukan. Profitability Index. Profitability Index, also known as Profit Investment Ratio and Value Investment Ratio, is the ratio of payoff to investment of a proposed project. It is useful tool for ranking projects because it allows you to quantify the amount of value created per unit of investment. So the profitability index is an appraisal technique applied to potential capital outlays. The method divides the projected capital inflow by the projected capital outflow to determine the profitability of a project. As indicated by the aforementioned formula, the profitability index uses the present value of future cash flows and the initial investment to represent the aforementioned variables. So next is the discounted payback period. The discounted payback period is a capital budgeting procedure used to determine the profitability of a project. A discounted payback period gives the number of years it takes to break even from undertaking the initial expenditure by discounting future cash flows and recognizing the time value of money. The metric is used to evaluate the feasibility and profitability of a given project. So, next is the non-discounted cash flow or unadjusted approach. First is the payback period. Second is the bailout period. Third is the payback reciprocal. And the fourth is the accounting rate return. Bailout period. When we say bailout period, it is when a business or an individual or government provides money or resources to a failing company. In conventional payback computations, investment salvage value is usually ignored. An approach which incorporates the salvage value in the payback computations is the bailout period. This is reached when the cumulative cash earnings plus the salvage value at the end of the particular year equals the original investment. So last is the payback period. When we say payback period, is the length of time it takes to recover the cost of an investment or the length of time of an investor needs to reach break-even point. So the payback period, the term payback period refers to the amount of time it takes to recover the cost. Simply put, it is the length of time investor issues. People and corporations mainly invest their money to get paid back, which is why the payback period is so important. In essence, the shorter payback an investment has, the more attractive it becomes. Determining the payback period is useful for anyone and can be done by dividing the initial investment by the average cash flows.
Good morning, everyone. My name is Sim Villasiran, the last reporter. So, payback reciprocal. The payback reciprocal is the payback period for an investment dividend by one. This reciprocal yields an approximation of the rate of return on an investment, though only when annual cash flows are uniformly even over the lifetime of the investment, and the cash flows from the project will continue forever. So, an example of payback reciprocal is, for example, a financial analyst is reviewing a possible investment of 50 pesos, which will generate positive cash flow of 10 pesos per year. The payback period is 5 years since the cash flow of 50 will accumulate over the next 5 years. The payback reciprocal is 1 to 5 years or 20%. So next is the accounting rate return. Accounting rate return or ARR is the average net income while it is arrived at through an asset is expected to generate dividend by its average capital cost. Expressed as an annual percentage, the ARR is a formula used to make capital budgeting decision. So, for example, if a new machine being considered for purchase will have an average investment cost of, for example, 100,000 pesos and generate an average annual profit increase of 20,000 pesos, the accounting rate of return will be 20%. So, ang 20% sa 100 is 20,000 pesos. So, mo na siya ang rate of return, accounting rate of return. Next is this is a selection problems, and there are three types of capital budgeting decision: are accept, reject decision. Second is a manual exclusive project decision, and lastly is capital rationing decision. So first, the accept and reject decision. This is a fundamental decision in capital budgeting. If the project is accepted, the firm would invest in it. If the proposal is rejected, the firm does not invest in it. In general, all those proposals which yield a rate of return greater than a certain required rate of return or cost of capital are accepted and the rest are rejected. By applying this criterion, all independent projects are accepted. Independent projects are the projects that do not compete with one another in such a way that our acceptance of one precludes the possibility of acceptance of another. Under the accept reject decision, all independent projects that satisfy the minimum investment criterion should be implemented. So, for example, a business firm is confronted with alternative investment proposal. If the proposal is accepted, the firm incur the investment and not otherwise. Broadly, all those investment proposals which yield a rate of return greater than cost of capital are accepted and the others are rejected. So, that is the accept reject decision. Next is mutually exclusive project decision. Mutually exclusive projects are those which compete with other projects in such a way that the acceptance of one will include the acceptance of the other projects. The alternative are mutually exclusive and only one may be chosen. Suppose a company is intended to buy a new folding machine. There are three competing brands, each with a different initial investment and operating cost. The three machines represent mutually exclusive alternative, as only one of these can be selected. Moreover, the mutually exclusive project decisions are not intended of the acceptance reject decision. The project should also be acceptable under the latter decision. Thus, mutually exclusive project acquires significance when more than one proposal is acceptable under the accept reject decision. And this is the mutually exclusive project reject. And the last one is capital rationing decision. In a situation where the firm has unlimited funds, all independent investment proposals yield returns greater than some predetermined level are accepted. However, this situation does not prevail in most of business firms in actual practice. They have a fixed capital budget and large number of investment proposals complete for these limited funds. The firm must therefore ration them the first allocate fund to projects in a manner that it maximizes long run returns. And that would be all. Thank you.